All right, guys, welcome to the 2016 November conference call. We've got a lot to talk about today, so let's get right into it. Let's start with the U.S. indexes. We've obviously seen a lot over the last week or so. Some of the things that had me a little bit concerned, like the S&P 1500 and the Russell 3000, which are much broader outlooks for the market. Broad-based indexes, they really came back hard. The small cap outperformance is something that is worth noting, and we'll get into that. Then we'll talk about some of the sectors. There's our favorites that like transports and financials that have absolutely exploded, so we couldn't be more thrilled. And then there's the other ones that we've hated, like discretionaries and healthcare, for example. And I got to tell you, they don't look that horrible. They're not breaking down, which is I would argue is a positive for the worst sectors. And if the worst sectors and they're rotating into some of those, I would argue that's constructive sector rotation. So we'll talk about that. I like crude oil long down here for sure. I still like the energy stocks as well, so I think that whole theme makes sense. I think that technology is still a place we need to be. We'll talk about a few of those. I really like that sector. I have for a while. That hasn't changed. Financials right now are hitting our upside objectives in a lot of cases. So, we want to be disciplined. We want to take profits. What happens after they hit our targets is not our problem anymore, right? So, we have our objectives. Our objectives are met. We move on, and we live to fight another day, and we'll let things reevaluate and move on. Gold and silver, guys. How long? We're going months. Since July, I've been saying this is a no touch. Stay out of this market, and gold and silver continue to struggle. And rates have obviously exploded. It's fun to see the media and people who don't know any better, talking about how this is because of Donald Trump and the election. And it's funny for us because we've been talking about shorting bonds, and rates are going higher for since the summer, well before any election or anything like that. So a little bit of humorous sort of activity from people who get paid to make noise instead of us who gets paid to make money, right? All right, so before we get going on the charts, as always, you guys know nothing we talk about here is any sort of solicitation to invest in any hedge fund that I manage, nor are these any buy or sell recommendations. Everything we talk about is strictly for informational purposes and educational purposes. Make sure if you're a professional that you discuss, what you're doing, and make sure that it's cool with your compliance department. And, for retail investors, just make sure that you've consulted your financial advisors and your accountants. And just make sure that you're suitable to be doing some of the things that we're talking about here today and in general. So with that said, short term, we've been super bullish. The Dow Jones Industrial Average, you guys know that. Our upside targets have been hit. It was about 1850 over here, and I think we need to be taking our profits short term in the equities market overall, and I think the Dow really shows that. And although I do think that we had higher in all of these indexes, I think some consolidation here is certainly warranted. I love that we hit overbought conditions in the Dow. Notice how we never hit oversold conditions. All of these are characteristics of uptrends and bullish markets. So rather than pressing these longs up here, we want to take profits and look to buy either after some consolidation or on some pullbacks lower. Dow Theory is something that we rarely talk about, because of the fact that the Dow Theory buy and sell signals are just so few and far between. So there's really not a lot to say. But when I see something that I think is worth noting, I'll definitely point it out. This is the first chart in the intermarket workbook in the chart book. So you can always check it out for yourself if you'd like. But I think what is worth noting is that we have now broken out in both the Dow Jones Industrial Average and the Dow Jones Transports. We had been waiting for a breakout above the April highs for a while to confirm what we saw in July out of the industrials. And we finally got that over the last couple of weeks. So definitely bullish. We want to be erring on the long side of stocks and look to be buying weakness in these areas for sure. Here's transports on their own. You guys know it's been my favorite sector for a while. This really just looked like a bottom, not a top. And, sure enough, we've broken out beautifully. And I think we're heading up toward this 9,200 area where we want to be taking profits in transports as a group. Here at transports relative to the S&P 500, if you guys recall, back in July, one of the reasons that I got so bullish on U.S. stocks and stocks as a group was that transports were breaking out on a relative basis. And, transports had been a great leading indicator for a while. It peaked before the S&P 500 in 2014, bottomed this year before the S&P 500 in January. So we look to the transports as leaders, and the argument was if the transports are outperforming the S&P 500, this was in July, we have to take that as constructive. We have to take that as bullish, not only for the transports, but the market overall, but obviously especially the transports. And we are quickly approaching this 420 resistance where has been our target since the beginning. Here's a Dow Jones Industrial Average relative to utilities, breaking out of this base from throughout 2016. I think that's bullish overall for equities. You want to see the industrials outperforming the utilities, the yield producing utilities. Notice during this decline in this ratio, equities were getting slaughtered. Look at August last year as well. So we want to see this ratio trending higher, and that's precisely what we have here, and momentum in a bullish range. So I'd argue this is another feather in the hat for the bulls. One of the things that had me concerned about the overall market was the Russell 3000. Let's remember this represents approximately 98% of all of the investable assets in the U.S. equities market. So, this thing not holding above last year's highs is something that I did not want to see. So now that we are breaking out and resolving this consolidation higher, I would argue is extremely constructive for equities, is bullish for sure. So again, if we are above the 2015 highs in the Russell 3000, again, we want to be erring on the long side of the equities market. Same thing with the Dow Jones Composite. This is the broadest based measure of the Dow Jones averages. So this includes the 30 industrials, the 20 transports, and the 15 utilities. So it's 65 names. And guys, this is not bearish. I don't know how else to put it. This is not a bearish looking scenario. This is a bullish. The original catalyst was the failed breakdown earlier this year. Notice how we have not hit oversold conditions, not once since then. And now these consolidations are resolving higher, not lower. So when you have these broad-based measures of the U.S. equities market, put the S&P 500 aside, you got the real measures, composite, the Russell 3000, and these are resolving higher. Guys, we got to take that as a positive. Now, the value line stuff, I think is super, super, important to look at. You have these are equally weighted averages. So I think that, again, getting back to that broad-based measure and the fact that we are resolving the value line geometric average is resolving this consolidation higher, fits in with that same theme that we're seeing in the Russell 3000 and in the Dow Composite. And here we are. Here's the arithmetic calculations, which you guys are curious on the differences. Just go to the U.S. averages workbook in the chart book, and below the weekly charts for each of the value line indexes, the arithmetic and the geometric, it's the explanations of how they're calculated. But I would argue that the value line index breaking out to an all-time high and resolving this several-month consolidation higher has to be taken as a bullish indication, especially when momentum never hit oversold conditions, and you put it within the context of what we're seeing in the other averages. Guys, it's just not bearish. So here's another one. Here's the Wilshire 5000. Again, you're seeing these broad-based measures of the equities market resolving higher. I don't care who you are, guys. This is not a bearish development in the Wilshire 5000. Here's a shorter-term look at the same chart. Looks awfully similar to the Russell 3000, looks similar to the composite. And notice this little failed breakdown that we got here. This is an interesting theme that we're going to talk about. We're seeing similar behavior where they tried to break down but couldn't hold. We're seeing that in things like Coca-Cola and Disney, and some of the stuff that we've hated for a while failed to break. So I would look at that as constructive, and we'll get into that in a minute. But just keep this theme in mind for the future. Now, here's something that I think is incredibly constructive for sure. You don't hear me talking about candlestick formations much here, but big engulfing patterns I think would be irresponsible to ignore. These are the Russell 2000 futures, and last week's last week's behavior engulfed the prior 18 weeks in just 1 week. So in other words, We made a lower low and a higher high in the same week, above and below the prior 18 weeks. Guys, I would argue that's extremely constructive, for obviously the Russell 2000 small cap index, but, I can't imagine something so bullish for the small caps is bearish for the rest of the market. I would chalk that up as another feather in the hat for the bulls. And then here's what the Russell 2000 ETF looks like short term. I hate that we got oversold, so we're definitely getting mixed signals in momentum. I would argue that this is there's some trouble here. I think it would be irresponsible not to recognize that. But guys, if we're above this 126.5 area, forget this little failed breakout. This one, I love the gap above that. Which goes to show you that this is the real resistance. This 126.5, 127. So if we're above that, I think we need to be long the Russell 2000. Here's another development that I think is positive for the bulls. These are the S&P 500 equally weighted index relative to the S&P 500. So in other words, the equally weighted index versus the market cap weighted index. And if you're seeing the equally weighted index outperforming, I think that is evidence of good breadth and expansion in participation. I love how we never hit oversold conditions during this correction. Notice how the bullish momentum divergence in early 2016 in this ratio and bullish divergence sparked the rally that coincided with the rally in equities as a group, as an asset class. So, again, something that we want to be watching. Also notice when this peaked. This peaked when the, slightly before the overall market peaked in May of last year. So another bullish development for sure. Here's another one, the Russell 2000. These are the small caps versus the Russell 1000 large caps. Small caps breaking out relative to large caps. To me, that's evidence of risk appetite out there. If these guys were scared and didn't want to be chasing into year end, we would be seeing the opposite. We would likely be seeing new lows in this ratio. In other words, flight to safety towards the large caps as opposed to aggressively investing in the small caps, right? That's how I look at it. Here's a shorter term look at that. I mean, we're talking about a multi-year downtrend channel resolving higher in small caps relative to large caps. Guys, this is not a bearish development. So the reason I'm showing you all of these charts is because they're all suggesting the exact same thing. These are all, in my opinion, very, very bullish developments across the board. It doesn't mean that we need to be chasing, anything that we may have missed out on or pressing longs, in some of the things that have exploded over the last couple of weeks. But it does mean that from a structural perspective, from a longer term outlook, we are in an uptrend. We are in a bull market in equities, and all of these charts and all of these ratios and all of this money flow really argues the same thing, and it's really nothing that should be surprising. These are a lot of themes that we've already been talking about for several months, well before any silly election. And I appreciate the fact that emails and stuff that you guys have sent me acknowledging that, showing me, the media making things up so they could sell, ads and commercials and stuff, when we know what really had been transpiring underneath the surface well before any election. So I do appreciate those emails, and I do laugh, just so you guys know. Here's an interesting development that I would not have, figured considering the rest of the evidence is this is growth really breaking down relative to value in the large cap names. So I think that's interesting. So when you're looking at large cap names, I know there's a lot of there's some mutual fund managers, some of you guys that work in mutual funds, some of you guys are RIAs. So when you're talking with your investors and things like that and deliberating whether you want to be in more large cap growth relative to large cap value or vice versa, I think that this chart really speaks volumes. Let's get into some individual names. This is American Airlines. You guys know transports have been my favorite space. So they've, other than maybe financials, have definitely had the best run in recent weeks. So let's get into a few of those that I've liked. This American Airlines continue to make higher highs, higher lows. This is a buy on any weakness. I don't know that we get back under 40 and into the high 30s, but if we do, I definitely think we need to be buying. I think we're heading back up towards the highs last year in the mid-50s. Avis is a name that I've liked. We are now breaking out. If we are above this 39 area, I think that we need to be long with the next target above right around 47, 48. This is for Avis Rent-A-Car. So here's C.H. Robinson. These are the truckers, continue to look good. Again, this doesn't look like a top. This looks like a continuation of sorts. And, although we don't want to be buying underneath this overhead supply, but instead wait for the breakout, I would argue the breakouts are coming eventually. Maybe we'll run into some trouble here, consolidate a little bit, and then break out. Or, in my opinion, the best case scenario would be a gap above that level, similar to what we saw in the Russell 2000. Here's CSX. As you guys know, this has been my favorite railroad. Continues to do well. I think we're heading back up towards this, the upper end of. Sorry about that. The upper end of this uptrend channel. I think that's where we're going and where we want to be taking profits. Here's a short-term look. This has just been an absolute beast. As long as we've been above 29, this has been a buy with a target up here in the high 30s. I would be a buyer of any weakness. I still love this. I think it goes a lot higher. Expeditors, another beast. Notice how, by the way, guys, notice how all of these, the order that I've been going in transports is an alphabetical order, because my chart book, the transports, is an alphabetical order, and I'm just going one by one, and so many are looking good. And, the reason I've been so bullish of transports, like, sure, the outperformance relative to S&Ps has definitely been one of the factors, obviously, but I would argue what's even more important is the actual list of stocks in the transports doing so well. And in last week's letter, I urged you guys to go through that chart book and go through each one of them one by one, and then come back to me and tell me that you're bearish. I mean, it's really that hard. So, people talk about scans and all these, ways to kind of, save time and things like that. I would argue throw those scans in the toilet and, really take the time to go through all of the charts. And, if you don't want to do that, I do it for you, right? So just go over there and take a look at it. I find it to be such a valuable exercise. And if you're going through using scans, you're missing out on that. And I would argue that had I used scans instead of just going through all the damn charts myself, I would have probably missed this move in transport. So Expeditors, another good one. I think we definitely break out of this consolidation. Here it is short term, guys. If we're above this 52 and change level, I think it's a buy. I think you got another 10% of upside at least. FedEx has been a beast, continues to make higher highs, higher lows. I think we're getting up towards 240. I think we have a long way to go in FedEx. UPS, same thing, but we're going in alphabetical order, guys. You can see how many transports look good. Here's JetBlue, freaking Airlines. These guys are terrible, and we're breaking out. So even though the worst areas are resolving higher instead of lower, and I can't take that as a bearish thing. So we want to be buying weakness in JetBlue, ideally down near 18 or something like that. I think we see new 52-week highs up in the high 20s for sure. Here's Landstar, not a name that I mention often, but I did a few weeks ago for the first time maybe in my entire life. What a beast it's been, really just goes to show you the power of the transports. What an absolute beast. Obviously, our targets have now been hit quicker than I thought, to be perfectly honest, but we'll take it when we can get it. Ryder, another animal, just an absolute beast. If you're still in this, this was our initial target near 78, but, if we can consolidate here, at this point, I would only be long if we're above 76. If we're below 76, we can't be in this because we likely need more consolidation. But if we can stay above that, I would argue Ryder is still a long. United Airlines, another disaster that continues to break out, one that we've wanted to buy, one that we've wanted to be long, and we are quickly approaching our target near 72. I think that's where we're headed. UPS, we talked about FedEx, but UPS too, another name that I've liked. I think we're heading up towards 120. We want to be buying on any and all dips. So these delivery companies just, they're giving us the same theme. They look great, guys. We need to be buying them. So here's an area that I've hated, healthcare. Here's healthcare relative to the S&P 500, okay? So we not only had the failed breakout, right? So you guys know that we want to be out of this thing forever, right? So not only did we have the failed breakout, but then we broke the uptrend line from the 2011 lows, right? So, this is still a problem on a relative basis. Momentum hit oversold. So this is still on a relative basis from any sort of structural perspective, nothing that we want to participate in. Here's a shorter term look. Yes, we have a bullish divergence. Yes, we're trying to find some support at the 38.2% Fibonacci retracement of the 2011 to 2015 rally. But no evidence that suggests to stop selling strength. This still suggests selling strength, nothing that we want to be buying. Here's healthcare on its own, right at a flat 200-day moving average. So if you like headaches, right, if headaches are something that you like having, I would suggest trading healthcare. If you're like me and headaches are not something that you like having, I would argue that right here at a flat 200-day moving average, it's an absolute no touch. But I will say that we're here and not down here is certainly a positive. It's step one to recovery, that's for sure. But not all is lost in the healthcare space, guys. Here's United Health, and I don't know what it is. Maybe they're part of the Dow Jones Industrial Average, which helps. I don't know. Quite frankly, I don't care either. So although healthcare is a sector that we don't like to buy as a group, United Healthcare breaking out to an all-time high this week, I can't look at that as a bearish characteristic, guys. When you write down your list of bearish characteristics of market trends, all-time highs are not on that list. So let's break it down and look closer. This is it, breaking to an all-time high, guys. If we're above this 146 area, again, if we're above this whole area here, that's not bearish. So while I'm not willing to chase this breakout simply because I don't like the sector, I think it would be irresponsible to ignore this. I think that, if we don't like healthcare as a group, that's fine. UNH looks great. So let's see how this kind of acts over the next couple of weeks. I think that's super interesting and something that I wanted to mention of the group that I don't like and I still don't like, but it's hard not to like the UNH. Here's consumer discretionaries relative to the S&P 500, another sector that I've hated for a while. Here it is breaking the uptrend line from the 2008-2009 lows. So again, not somewhere where we want to be getting long. Here it is short term. These are consumer discretionaries relative to the S&P 500, breaking down, resolving this consolidation down, not higher, momentum in a bearish range as well. So from any sort of structural or tactical perspective, consumer discretionary is just not a place where we want to be piling into, right? Speaking of which, Amazon is the largest component of the consumer discretionary space, not a technology company, contrary to popular belief. In fact, it represents 0% of the technology sector, and this has already hit our upside objective. So there's been no reason to buy it. I think this is still a fade towards 830. Momentum's now oversold, so this is probably going to be a mess here for a while, in between 700 and 800 and change. That's what I would argue. So either trade that accordingly and maybe trade that range if you have to be in it. But just know that there's still plenty of overhead supply and no reason to be long. Same thing with Netflix, right? So another consumer discretionary stock, not a technology stock. Our upside objective, as bullish as we were back here under 100, our upside objectives were hit several weeks ago, and we talked about that. So there's been no reason to own Netflix. I still don't think there is. Sure, can we find support here at form of resistance? Sure, I would still be fading this area. So I think that we're stuck in this range for now. If you want to trade the range or whatever, do that accordingly. If you must, I would argue that if we don't get oversold, I think that that's super constructive. Amazon, we already got oversold. So that's step one. Number two, 1, 2, 3 times we've tested this level. So the more times the level is tested, the higher the likelihood that it breaks. My crystal ball is in the shop right now, but if I had to guess, I would argue that this massive multi-year consolidation is going to resolve higher. Maybe not tomorrow, maybe not next week, probably not even this year. But that breakout, I think, is going to be massive. And as I say, the bigger the base, the higher in space. So if and when we do break out of this consolidation, I would expect a monster move. The measured move here is, roughly 40 points or so down here to up here. You can even say 50 points if you want to be aggressive. But just on a conservative basis, just a simple conservative measured move, you're looking at a $170, $175 stock in Netflix. So just something to keep in mind, bigger picture. Industrials, guys, what can we say? What a great sector this has turned into. Something that had been a mess for years, tried to break down, failed to break down, and it looks now like it's going to resolve higher. Like Netflix, this is now testing resistance for the third time. The more times that the level is tested, the higher the likelihood that it breaks. So industrials relative to the overall market is definitely something that we want to be looking towards. Notice how healthcare is breaking down relative to the market. Discretionaries are breaking down relative to the market. Industrials are breaking out relative to the market, right? You notice the difference? Here it is on a shorter term outlook. That consolidation resolved higher. We're getting upside resolutions in industrials. So although on a relative basis we are running into trouble, we definitely want to take the bigger picture outlook based on the previous chart. And I think that any weakness in industrials needs to be bought, particularly relative to the overall market, and I do think that we break out. Here's industrials on its own, finally got above this level. If we're above 58, we want to be long XLI, target above 65, that hasn't changed. We want to be buyers of any dips in industrials. Within the industrial space, I've loved aerospace and defense. You guys know that. I absolutely loved it. That's where the strength was, and our upside objectives above 141 were hit this week. So take profits accordingly. Caterpillar continues to do well. I love this name in the industrial space. If we're above 90, we want to be long. Only if we're above 90, target above 111. These are the highs in 2014. Financials, guys. What can I say? I mean, there's just I don't even know where to start. What an incredible move we've just seen in financials. I love that they're blaming Trump and everything like that. You guys know that financials have been looking good for months and months, well before, we knew that Donald Trump would be president of the United States and everything like that. So what a monster move in financials. Here's XLF relative to the S&P 500 breaking out. So from a structural perspective, I would argue that this is a bullish development. Short term, however, we have now hit our upside objectives in financials relative to the overall market. So if you've been super overweight financials, have a lot of exposure in your portfolio, number one, kudos to you for sure. But I would start peeling that back for sure now that our upside objectives have been hit. Here is a shorter term look at XLF relative to the overall market. Longer term look, excuse me, and just to show you how we have broken out of a major consolidation. So, sure, do we want to be chasing this? Of course not. Our upside objectives have been hit, as we mentioned, but I think on any of these pullbacks that we're going to get or consolidation, I think it needs to be bought in the future. Here's the BKX, here's the bank index relative to the S&P 500. Remember that we wanted to be buying this when we not only found support at the 2011 lows, but also the bullish momentum divergence. We have now broken out. So although we don't want to be chasing at this overhead supply, I think it's important to point out, what's happened here in the banking stocks. Same thing with regional banks. Guys, I mean, we're talking about a multi-year consolidation here, resolving higher, in this, this is regional banks relative to REITs, excuse me, not the S&P 500. So this is basically an indicator of interest rates. One of the reasons we've been super bearish bonds since the summer was this failed breakdown and bullish momentum divergence. And then sure enough, we've now broken out. So which fits perfectly with what we've seen in the U.S. interest rate market, right? So I continue to think that this suggests rates are going higher, and we'll get into rates at the end of the conference call, because rates are hit our upside objectives as well, 10s and 30s. So covering bond shorts across the board. But I think that this chart of regional banks relative to REITs, KRE, IYR, suggests that we've been on the money, and as long as we stay above this, I think we need to err on the side of higher rates. So here's Bank of America, absolute beast, hit our target last week, so we wanted to be taking profits. However, now that we're above this, on pullbacks, anything like that, I think moving forward, if we're above 1840, 1844. We're above that, I think we can be long with a target of 23, right? So, kind of let things consolidate, let things pull back, whatever it is. If we get an opportunity to buy this under 19, I think we should, and I think we're going to 23. That's potentially a 20% move. I mean, that's not nothing. So insurance companies, as you guys know, I've loved it. Here's IAK, the insurance sector, hit our upside target, so we want to be taking profits on that for sure. Broker-dealers, same thing, beautiful breakout. We want it to be long, hit our upside objectives this week, so take profit. So, the one theme that I think that we can all agree on with financials is the fact that a lot of our upside objectives have been hit, right? Here's Jpmorgan, same thing. It's been one of my favorites, and we hit 80 bucks this week. Upside objectives reached. So, maybe, if we're down in the low 70s, we could buy that again. But right now, it's a fade. Upside objectives hit. So, big theme there in financials. Something that has not broken out that I think is next is in the energy space. I think that we get a breakout in energy relative to the S&P 500. This is XLE SPY, and I think that this resolves higher. Here's XLE on its own. We want to be long if we're above 70, 69.5-ish, and take profits above 80. So I like energy for sure. OIH, we want to buy this breakout if we are above the downtrend line from late last year's highs. OIH is long. Those are the oil services. This is XOP. These are the explorers and producers. Monster base, in my opinion. The bigger the base, the higher in space. This looks a lot like the Dow Jones transportation stocks, several months ago, or a month ago for that matter. So I do think that these break out. Notice how we did not hit oversold conditions. So the XOP, the explorers and producers, go nuts. I love them. Here the the airlines. So getting back to the transports, here's looking at it as a group. The airlines. We talked about American Airlines and United. But here's the whole group really breaking out, and JetBlue we talked about too. So I do think airlines go and retest last year's highs. I think that's where we're headed. The railroads, you guys know how much I've loved them. Continue to break out, make new highs. Momentum never hit oversold, and I think we're getting back towards the 2015 highs. So I think we got a long way to go in the rails. Same thing with the trucks. We've just broken out. I think the Dow Jones Trucking Index heads up towards 670. So if we're above these highs, I think we want to be buying truckers for sure. Materials, I think, are next. I like this space for sure. If we're above, let's call it 47, we want to be long the XLB, take profits at last year's highs. The agriculture, the agribusiness space, if we're above 50, we want to be long. I think we go to 58. That's another 15, 17%, depending on your entry point. I like the agribusiness space. Chemicals as well. All of these are under the materials, so they all make sense. I think chemicals break out here as well. This is all under the material space, and my favorite continues to be DuPont. I think that we get this breakout. I really do, and if we're above 68, I think we could be long, and I think we're going above 80. Gold miners continue to be a mess. New lows this week should not be surprising to any of us. We talked about this for months and months and months, how it's been a no touch. I mean, ever since this uptrend line was broken, why bother with the gold miners? We're in a downtrend. So, at this point, it's a sell on any strength into the mid-20s for sure. The metals and mining, we're quickly approaching our upside target, 31.5, 31.60 in the XME. Freeport, Macmoran hit our upside target this week of 14. Guys, that was a monster move. We're talking about a 50% move in Freeport. So I hope a lot of you guys took advantage of that. Steel stocks also hitting our upside objective near 37. So, trade accordingly. Freeport, the metals and mining, the steel, that whole space is hitting our upside target. So take profits accordingly. Getting back to the financials as a group, which is something that I wanted to point to. This consolidation that we've seen is resolving higher, guys. So, when you're looking at financials as an entire group, although short-term our upside objectives have been hit, I think bigger picture, we need to acknowledge the fact that we are resolving higher, and I think ultimately can get back to their 2007 highs. I really do. So, let's let things settle before we start getting aggressive on the financial front again. But bigger picture, I think that's positive. Within that space, American Express is a name that we've liked. We want to be long if we're above 67. That hasn't changed. We want to take profits near 78. Goldman Sachs, absolute beast. We're quickly approaching our target near 218. We want to be taking profits up there for sure. Berkshire Hathaway, what an absolute beast. We've wanted to be long this space for a month now, and I still think it's going towards 170. Wells Fargo, wow. This gets back to real, risk appetite. And, I said it down here that if you want to be long for a punt, if we're above 44.5, you can be long all day. Boy, did that work. I suggested taking profits around 50. Once again, the market proving that it does not care what JC thinks, and it went almost to $54. So what a beast. We want to be buyers of Wells Fargo on dips towards 50. and be long if we're above 50. And I think that we're heading back up towards 60. So although tremendous move, obviously we've wanted to take profits. I think moving forward, any weakness towards 50 should be bought in Wells. Morgan Stanley, another financial that I like very much, as you guys know. The idea was to be long if we're above this uptrend line from the summer this year, and our upside objectives were hit this week. So take profits accordingly. Semiconductors have not hit our upside objectives. Semiconductors we look to as a leading indicator for technology as a group. So the fact that semis are still making higher highs here, and we're seeing a ton of strength out of the technology small caps also making new highs. So I think technology is still a place that we need to be here. The internet stocks, if we're above 78 in the Dow Jones Internet Index Fund, we want to be long with a target above 91. So, go to the Dow Jones Internet Index and see what the components are. Obviously they're your favorite names, the Facebooks and Amazons and Googles of the world and everything like that. So this is a group that we want to be buying if this index is above 78. Cisco, still love it. I think we're going to 36 and change. If we're above this downtrend line, we want to be long. Here's a closer look. We're pushing up against new highs. But, if we're above 29, I think we need to be long for a trade up towards 36. It's 20% from 29. IBM, still a name I like. If we're above 154, we want to be long. Price target is 178, which was former support, and a key Fibonacci retracement. So IBM still a long. Microsoft still a long if we're above 56.80. If we're above that, we need to be long, guys, with a target of 62. I think that's where we're headed. And of the large cap tech, it's held up, considering some of them have gotten hit. Apple, I think, has held up as well. If we're above 110, we can be long Apple, with a target back up towards 130. So if we're above 110, we can be long Apple. Twitter, I still like. If we're above 17, this is a long. I think we're going up to the high 20s. So in the smaller, maybe not small cap, but smaller cap tech, relative to the $400 billion monsters that we've mentioned, I would argue Twitter's a little guy, a relative basis, but nonetheless, one that we want to be buying if we're above 17. I think that this looks more like a bottom than a top. So now I want to talk about some of the things that I've hated, and some of the stuff that we've wanted to stay away from. And then I want to show you kind of a common theme that we're seeing, right? So remember when I brought up, what was it that I brought up? It was the, which one was it? It was the, was it the Russell 3000 or the Wilshire? One of those that kind of broke down briefly and then quickly came back. Here's the retailers that I've hated forever, trying to break down a couple of weeks ago and couldn't. The bears couldn't hold it. And we're now back above that downtrend line. So I would argue, while I don't want to be piling into retailers, I would argue that this is extremely constructive and something to take note of, that the stuff that we've hated the most is actually looking good, right? So same thing with autos, right? Autos are not crashing. They're kind of hanging in there. While we don't want to be piling into autos, I think it's something constructive that we need to take note of. These are the home builders. Sorry, not XLB. This is XHB. Excuse me for the typo. Again, tried to break down a couple of weeks ago. Couldn't. The bears couldn't hold it down. We're now back above. So while we might not want to be buying home builders, XHB, at a flat 200-day moving average, the fact that they couldn't break down, we have to take that as constructive. Walt Disney, same thing. The breakdown could not hold a couple of months ago. Bullish momentum divergence. So while we don't want to be piling into Disney, another positive development. Coca-Cola, it's trying to break down. Momentum's not confirming. Coca-Cola gets back above certain levels. It's not a bad thing, guys. And when I talk about it's not a bad thing for these individual stocks, yes, that is true. But I would argue that it's good for the overall market if the worst stuff can't break down, right? I would argue that's a positive. McDonald's, same thing. They try to break it down. Bullish momentum divergence, resolving higher. While, again, we don't want to be piling into Mickey D's at a flat 200-day moving average, the fact that the bears couldn't hold it down, I think it's great. I think it's a positive. Same thing with 3M. The bears couldn't hold it down. So if the worst stocks and the worst sectors are hanging in there, how bad? That's a good thing. Biotechnology, another one that we wanted to stay away from for good reason. I mean, we went nowhere. Again, the bears couldn't hold it down. Finally got oversold, but the bears couldn't hold it down. So again, while we don't want to be piling into biotechs, another positive development, guys. So looking internationally, seeing some interesting stuff. I mean, America is the best place out there for sure. I mean, there's just no doubt about it. The strongest market in the world. You know, London's not too far behind. Canada's not too far behind. But the U.S. by far and away is the best place to be, especially compared to Europe. So this is Europe versus the U.S. We're holding below support. This, to me, suggests the U.S. continues to outperform Europe. So as this declines, that's U.S. outperforming Europe. So I think that that is still, you know, where we want to be. Here are European banks versus Europe. I mean, they're just hanging in there. I really, really want to see a breakout in the banks relative to European banks relative to Europe as a whole. I really, really want to see it resolve higher, not resolve lower, because remember, I'm a stock market bull, and it resolving lower, I would argue, is a negative catalyst for equities. China versus U.S. breaking out. China, man, never hit oversold. I think this heads higher, so I think if China's outperforming the U.S., I think that's an interesting theme. You know, the fact that we like materials, the fact that we like industrials, seems to fit within that theme, I think. Latin America versus emerging markets, beautiful breakout. We are now pulling back and retesting this breakout. As long as this is successful, I would argue that this is good for emerging markets. It's good for Latin America. You know, it's good for that whole theme of trades. So it's something that we want to see hold and make new highs. Canada. Guys, you know, Canada has been consolidating nicely. I think we're heading up towards 15 over 15.5 in the TSX. You know, we want to be, if we do get a flush, you know, this resolves lower, kind of comes down here, and then we want to be buying that dip. But either way, I like Canada. I think we're going higher. This is Europe. While it doesn't look great, while we don't want to be buying it yet until we see some kind of breakout or upside resolution, the fact that we're not down here crashing, I think is super constructive. Here's Germany breaking out of a multi-year, two-year downtrend, right, channel, and now resolving higher. Again, you know, we don't even have to be ripping in the German DAX, but we're not down here, guys. So if things were so bad, we'd be down here, not making new year-to-date highs, right? Deutsche Bank. I mean, this has been the cancer of the European banking system, European stocks, financials, and sure enough, we've exploded higher. So, you know, a lot of gloom and doomers really pressing shorts down here. Meanwhile, I'm suggesting taking punt longs and being long above 12. And boy, has that worked. You know, real, you know, beautiful moves higher. And again, at this point, you know, our upside objectives are being achieved. So not something I want to be buying, but the fact that we're not down here making new lows, I think is constructive. I think it's part of this basing process. And now, by the way, momentum has hit overbought conditions, so we are now in a bullish range. France, same thing. You know, put it with the Euro Stocks 50 or 600 for that matter. You know, put it with the DAX. Again, maybe not something we want to be buying until we break out, but the fact that we're not down here in France, I think, is super constructive. Japan, same thing. We're not down here. We're breaking out. We're resolving this, you know, a year-long base, basically, higher. That's a bullish catalyst. So maybe I don't want to be piling into Japanese equities today. You know, maybe a little bit more consolidation, perhaps. This is constructive, and I think we'll be piling into Japanese equities shortly. Here's the ACWI index. So this is the all-world index. You know, consists of 20-something emerging markets, 20-something developed markets, so almost 50 markets. And I think that this looks constructive and that we're going higher. So we want to be erring on the bullish side for sure. So we want to be taking profits, obviously, where we want where profits need to be taken. But just, you know, when we walk into the office in the morning or into our desk or whatever it is, you know, we don't want to be shorting rallies. We want to be buying sell-offs, buying dips in equities. That's what this suggests to me anyway. Here's China on its own. There's the Shanghai Composite continuing to make higher highs, higher lows. You know, I think we're heading up towards 3,500 in Shanghai. That hasn't changed. Something super interesting that I wanted to bring up. This is Saudi Arabia. This is the TASI in Saudi Arabia. Look at this beautiful double bottom in Saudi stocks. And if things were so bad in the equities market and, you know, we're crashing and the world's going into a new bear market or whatever it is that these gloom and doomers continue to suggest, I don't know why they'd be piling into Saudi Arabia, you know, Saudi stocks. You know, this to me looks constructive. And then, you know, when you compare it to crude oil prices, you know, notice this key low in the summer of last year. Notice the double bottom at the beginning of this year, and then notice how we are now breaking out higher. I think this suggests that crude oil is heading higher as well. So this is something that we want to be buying. If we're above 43 bucks in crude oil, I want to be long and strong, guys. I want to be long crude oil, and I want to be taking profits near 62. I think we got a long way to go. Here's the Crb Index. This is the one that is the newer Crb that has like 30-something% energy. This to me looks like a bottom. We haven't broken out yet, but to me suggests we're going higher. Here is the older Crb Index, the CCI, which is more equally weighted, less exposure to energy. It also looks like a bottom that we, I think, had higher. So it really fits in with that whole crude oil theme, in my opinion. Gold continues to make lower lows, lower highs. No reason to buy this. We don't want to be buying this dip. We want to be selling any rips in this direction. It's kind of like, how I want to approach it. Same thing in silver, right? These are not bullish characteristics at all. So while bigger picture, we might have some longer-term upside objectives, the opportunity cost to be in this market continues to be way too much for me. Meanwhile, here's an equally weighted precious metals basket. So this is equally weighted gold, silver, and platinum. Not an uptrend, guys. I mean, I don't know how else to put it. So, not something that we want to be buying, and I think this is a good chart. Copper, meanwhile, you guys know I've been pounding the table on base metals. I love this space. And, we've hit our upside objectives this week in copper, so take profits accordingly. But I think bigger picture, after some consolidation or perhaps a pullback, I think we eventually head back up towards 3 bucks. So base metal, still something that we want to be buying on dips. And let me explain to you why. Here's aluminum breaking out, not breaking down. Here's nickel breaking out, not breaking down. Here's zinc making multi-year highs, breaking out, not breaking down. Lead, again, breaking out, not breaking down. There's a theme going on in the base metals. So while short-term, our upside objectives have now been met, right? This is an equally weighted basket of copper, aluminum, zinc, lead, tin, and nickel, right? Equally weighted, and we are now running into former support and downtrend line from 2011. So this is not a place where we want to be pressing longs in base metals, but important to recognize all of these themes that we're seeing in zinc and lead and tin in the base metal complex, to me, suggests there's something bigger going on, in commodities, particularly in base metals. So, while we want to be taking short-term profits in this space, I think bigger picture, things look very good. Coffee, our upside objectives have not been hit. I think we're heading towards 180 in coffee. So something we want to be buying on weakness. Here's a short-term look. Guys, if we're above 155, I think we can be long coffee and take profits above 180. Cocoa, something that looks terrible. I really did believe that this massive consolidation was going to resolve higher, and we were going to get a monster squeeze back towards the highs from 1977 in cocoa, and boy, was I wrong. See, that's why we wait for breakouts before getting involved, right? So that actually resolved lower. So, cocoa is now a disaster. We want to be sellers of any strength. This is not something we want to be bottom fishing at all. Getting to the currencies, we've had quite the rally in the dollar. And guys, I think a dollar breakout is certainly possible here. We've been waiting patiently. We had a monster base, the rally, and then, in March of last year, I was very aggressively suggesting fading dollars. Was the most bullish sentiment in the U.S. dollar we've ever seen. And sure enough, we've gone nowhere for almost 2 years. So, theoretically, this consolidation should resolve in the direction of the underlying trend, which in this case is higher. So we've been under the presumption that we're going to break out, although, like we've suggested, this is something that we want to wait for, right? Not something that we want to anticipate. And here's a shorter term look. We broke the downtrend line from last year's highs, and we're not bumping up against this area here around 100 for the third time. And the $100 level is, number one, a psychologically relevant level, but number two, represents resistance going back a couple of years. So the more times the level is tested, the higher the likelihood that it breaks. And I think eventually the U.S. dollar is going to break out. So we still have a flat 200-day moving average. Perhaps we need some more consolidation, maybe another pullback. But this, to me, suggests higher U.S. dollar prices. And then the victim in this will be the euro, represents almost 60% of the U.S. dollar index. This, to me, suggests we get a downside breakout in euro and head down towards the low 80s. Get below par and, really have a swoosh lower in Europe. I don't know what's going to cause that. I don't know how the European banks or European stocks are going to react to that sort of thing. Looking at things priced in euro, if the euro's getting slaughtered, anything priced in euro will look more attractive and will have a higher price. So, if you're looking for a catalyst, perhaps to what's going to finally make Europe break out, maybe the euro crashing will not necessarily be such a bad thing. So, something to keep in mind, not something totally actionable today, more of a conversation over cocktails or at a cocktail party or whatever. But nonetheless, something that I think that we should keep in the back of our minds moving forward for sure. Here's a short-term look at euro breaking the uptrend line from last year's lows, and heading back down to the support level. Never hit overbought conditions on these rallies. So I definitely think that we're heading down towards 105. And realistically, I'd be surprised if that didn't break. On the flip side of the coin, here's your dollar strength, particularly versus yen. So this is yen weakness. If you're looking for a catalyst that's going to break, that's going to break the Japanese equities higher, this is a good one. Dollar yen and Nikkei really trade very closely together. So, I look forward to hearing all of the conversations in early next year about, do we own Japan priced in yen or Japan priced in dollars? Do we own Europe priced in dollars or do we own Europe priced in euro? And I think from everything that we're seeing, I think we want to be buying these indexes, maybe not today, but when we do, I think we want to be buying them in their own currencies, not in U.S. dollars. We don't want to be in a situation where the denominator continues to appreciate in value and therefore, causes the investment itself to not go up in value, right? Because the denominator is really controlling that. So I think if we're looking at Japan and Europe, we want to own it in their currencies, not in U.S. dollars. So, and if you guys have any questions on that, email me. There's some different ETFs and things like that where you can do that, and futures as well. Dollar Swissy, more evidence of dollar strength. I've been waiting for this breakout for what feels like freaking forever, and I think we're getting it. If dollar Swissy is breaking out, again, another feather in the hat for the dollar bulls. Aussie Yen, great one. Further evidence of yen weakness. This Aussie Yen cross, not only are we, breaking out of a 1.5 year long downtrend channel, which is bullish for this currency itself. If you want to buy it, belong above 80. But I think that this really suggests risk appetite for Asian markets. There's really a lot of demand for, whatever, exports, imports, all that stuff. This particular currency cross really suggests a lot, to me, a risk appetite in North Asia, Northeast Asia. I want to finish up with bonds and interest rates. I mean, we've seen some pretty incredible moves, as we've already discussed. But here, Treasury bonds relative to the S&P 500, breaking down, not breaking out. So I think this suggests stocks over bonds all day. Back in my bearish days, last year, really last year when I was the most bearish on the equities market, we got bullish in January. But last year when I was super bearish, one of my thesis was that this was a massive bottom in bonds relative to equities, right? And we were going to break out, but this breakdown invalidates that entire thesis, which I think suggests that stocks over bonds all day. So we want to be selling rips in bonds, and we want to be buying dips in stocks, right? That's what this suggests to me. Here is the S&P 500 versus the 10-year Treasury note. So again, stocks versus bonds, making new all-time highs, guys, new all-time highs. So we're making new highs in this. Again, we want to be buying dips in stocks, selling rips in bonds. That's what this suggests to me. Here's a short-term look at that. I think we're heading back up towards 19 in the ratio. This is the S&P 500 relative to U.S. 10-year notes, and making new highs, resolving higher, not lower. So again, suggests buying dips in stocks, selling rips in bonds. Our target in bonds, TLT short. This has been a hell of a short, so super thrilled, obviously. But our target near 120 was hit this week, so we want to be covering bond shorts. 10-year yield, 2% was our target. We've now hit that. So as bullish as we were yields and bearish bonds because of this failed breakdown and everything, you guys remember, our targets have been hit. So cover bond shorts. That's what this suggests to me. Now, bigger picture, here's the 10-year Treasury note breaking an uptrend line from the 1984 lows. So I think that this, although short term we want to be, covering our shorts and bonds, bigger picture, I think there's more trouble ahead. 30-year yields, our target was 3%. We've now hit that. So again, further evidence to cover bond shorts. Remember, this was probably the biggest reason why I've wanted to be short bonds. Charts don't get cleaner than this, this was really the one that really told the story, I think. Really had me pressing bond shorts, and to me this suggests there's more downside. So while short term, sure, targets have been hit, I do think there's a lot more selling pressure than buying pressure. We want to be selling any and all strength in bonds. Municipals, munis getting killed, guys, killed. We want to be selling strength, any strength in munis. This is not an area we want to be. With higher rates, these munis are getting murdered. Junk bonds versus treasury bonds, right? So this is really evidence of risk appetite in the bond market, which is confirming the risk appetite we're seeing in the stock market. Remember, guys, bonds, traditionally the bond market's smarter than the stock market, maybe, but from our perspective, we want to look at them both, right? And who cares which one's smarter? We want to see one confirming the other. And to me, junk bonds outperforming treasuries, continuing to outperform, suggests to me risk appetite in bonds. Here's a shorter term look at that, junk versus treasuries. This is a massive failed breakdown below that former support. I think we have a lot more room in junk bonds versus treasury bonds, which to me confirms the risk appetite we're seeing in equities, and I think is a positive for stocks. And then finally here, junk bonds versus investment grade bonds, right? So, the bad stuff versus the, the less bad stuff, I guess. Seeing junk outperforming investment grade, really suggests is similar evidence to what we're seeing in, junk versus treasuries, right? A flight to, the garbage, that real evidence of risk appetite. So, with that, guys, I will end it there. I will end it there. And if you guys have any questions at all, feel free to email me. You guys know I always get back to you. I hope that this really, laid out my case. I do the best I can every week and every month on the conference calls to really kind of lay out my case, my base case, why we want to be long or why we want to be short, examples, I'm presenting the evidence, right? And it's all about taking that weight of all of the evidence and then formulating a thesis and then executing accordingly. In some cases, we're getting fresh breakouts confirming those theses. In some cases, we are hitting our upside targets where we want to be taking profits, which although short-term, might be a negative catalyst, bigger picture, things still look good, things like financials and whatnot. Aerospace and defense, things like that. And then the worst stuff that we're seeing out there doesn't really look that bad. So, that's really my base case, guys. So, no biases. I don't care about, when I'm wearing my, technician hat, I don't care about politics. I don't care about, the government and jobs, and I don't care. I don't care about any of these things. I really just want to see money flowing. I want to identify trends, and I think I've done that here today. So I hope you appreciate where I'm coming from. Completely unbiased opinions, and we've had a good run in recent weeks with a lot of our favorite names. So let's appreciate that. Let's take profits where we need to. Let's not reiterate, as Babe Ruth said, right? Yesterday's home runs don't win today's game. So, we'll take our profits, we'll move on, and we'll look for more opportunities. And I think there are plenty out there. So, all right, guys, we're entering the holidays here. So, be careful with whipsaw moves, days like the day after Thanksgiving, or days like, between Christmas and New Year's. There's funky stuff tends to take place on those days. So, just make sure that that you're aware of that. So, thanks again for everybody coming. And if you have any questions, you know where to find me.